Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. In the past week or so, I received a request on social media to tackle the concept of when to sell a share here on Supernatural Stocks. Now, that is probably the hardest topic of it all when it comes to investing, but I'm going to give it my best shot. Thank you to that listener for the suggestion, and please do keep them coming. Option 1. This stock is for sale in 2000 and never. Once upon a time, people thought diamonds are forever. Well, at least that's what De Beers kept telling us in their marketing. Lab-grown diamond disruption has taught us that this may well not be true. This is an important lesson for those who believe that they will hold a share forever. Even Warren Buffett sells shares at a point in time, and even he can end up kicking himself, selling too early and watching the share price continue to run. This immediately gives us another 2 lessons. Being a long-term investor is not the same as never selling. And secondly, you will lose your mind in the market if you retrospectively assess every decision you make with the benefit of hindsight. Of course, that doesn't mean that you shouldn't learn from mistakes. You just need to separate genuine mistakes from the impossible goal of trying to have perfect timing. So here's a personal lesson that I learned the very hard way. Transaction capital. As local stocks go, this was my ride or die. This was my forever stock. SA Taxi seemed like a terrific business. Yes, I know, but hindsight and all that. I mean, if Sabvest got caught out and Chris Seabrook was very close to Transaction Capital, what chance did the rest of us have to know what was really going on there? Plus, Transaction Capital Risk Services, which is now called Newton, was a pretty cute underpinning the group, and We Buy Cars was the growth asset that I believed very strongly in. I'd worked with the Transaction Capital management team several years earlier in an advisory capacity, and I felt like I understood enough to back them to keep allocating capital properly. The stage was set. For disappointment, of course. Why? Because I was silly. I'm not even talking about the business blowing up and the effect the pandemic had on SA Taxi. You can't foresee that stuff. It's just randomness in the market. That's why it's called risk. I'm talking about the valuation. I should have sold when the share price got crazy. I especially should have sold when the head of the Transaction Capital Risk Services business at the time sold his shares. And I distinctly recall thinking about it at the time and deciding to be greedy instead. What is that saying about the pigs? Ah yes, bulls make money, bears make money, but the pigs get slaughtered. Now, I was the pig, and I got slaughtered. I may have gotten slaughtered through what turned out to be a terribly broken balance sheet in the end, but in reality I deserved it. I had attached a forever label to a stock. Conditional love. That is the love you need for your stocks. Keep that unconditional, forever, no matter what love for your kids, and maybe your dog, or your cat in my case. And maybe don't ignore it when directors are selling shares that are clearly trading at a hot valuation. That's important information, no matter how much you love a stock. Option 2. There's a selling price, and I'm sticking to it. Welcome to the world of trading. You have a target price. You have technical indicators that give you an idea of the right entry points, based on all kinds of things from momentum indicators through to some more esoteric stuff that starts to sound a little bit more like trying to read tea leaves than anything else. But regardless of what it is that makes you finally pull the trigger on the way in, there is usually a specific plan for the way out. There's a price at which you've already promised yourself that you'll sell. In fact, you've probably already put that order into your trading system. Now, this is not investing. This is trading. If the trade runs for a slightly longer period, then it might fall into what is commonly called swing trading, where positions are given more time to play out. But the selling price is determined regardless with reference to things like key resistance levels or Fibonacci projections, not what the cash flow multiple would be at that point in time. Great traders are absolute experts at 2 things. The first one is reading charts, which means reading the market, and the second one is sticking to a plan. If you talk to traders or you listen to podcasts with traders, something that I believe is a worthwhile thing to do, even if you're a hardcore investor, then you'll pick up on a key trend. Most of their regrets come from not sticking to the trading plan. In other words, not selling at the target price like they promised themselves they would do, hanging on for more. Traders and investors, maybe not so different after all, right? The pigs get slaughtered in both cases. Option 3 is the best of both worlds. Deciding that you'll hold something forever is clearly problematic. We've now shown that. Having a predetermined target price at which you'll definitely sell in the short term makes you a trader, not an investor, and it means you'll have to constantly put in the work to find new opportunities instead of just letting your money compound over time to new highs. So, is there something in the middle? Well, of course there is. There is a wide open world in the middle, a huge spectrum of different styles and approaches. That's what makes this such a fascinating topic. It's also why it was important to get those bookends in place, as we now understand the styles that you'll find at either end of the spectrum. So what follows is a framework that I think could be useful and that I usually apply myself. I've come up with it, and feedback is always appreciated, especially constructive criticism. Question 1. What is the chart telling me? Now, I'm deliberately starting with the chart rather than the other stuff that you need to go off and think about yourself. Why? Because the market is filled with people looking at the same asset as you, hence that chart is valuable. Why not take their thoughts into consideration instead of working in isolation to start with? It's like asking the audience on Who Wants to Be a Millionaire, except you get to do it constantly instead of just once as a lifeline. Simply, is the chart on a one-way ticket to the top right of the page, or is there an indication of it starting to consolidate or even roll over? Momentum is the most powerful force in the market, and it can really drive prices to silly levels, ramping up profits for those who are sitting long. Traders, I quote, let their winners run, and with good reason. But they also look very, very closely for when the sign above the exit door is shining brightly. When a stock is overextended, it's time to get nervous. But if it still has room to go and the momentum behind it is strong, then it's probably not time to sell just yet, or you might end up kicking yourself. So, start with the chart and see what everyone else in the market thinks before you go off and apply your own mind. Second question that I ask myself is, what is common sense telling me? Now, you won't find common sense on a chart, and despite the name, you won't find common sense everywhere you look either. People try really hard to believe whatever suits their needs at the time. If it seems like nothing can go wrong, then they look hard to find reasons why that would be the case. This is classic confirmation bias, and we all do it. This is why you cannot only look at the charts. Yes, momentum is a beautiful thing, but when it runs out, a share price can roll over extremely quickly. In the time it takes you to make a coffee at work, the share price can be down 15%, and you're left with regrets unless you set trailing stop losses that moved up as the price moved up. So why common sense? Because a business that is simpler to understand is also easier and arguably less risky to hang on to. Back to the transaction capital example. It was clearly a very complex group with many underlying exposures and a few scary ones that I conveniently ignored through exuberance around We Buy Cars. We know how that ended. Thankfully, I now have We Buy Cars directly, and that position has done incredibly well this year. Am I making the same mistake again by holding on to We Buy Cars? Well, the difference here, I think, is that We Buy Cars is a pretty simple business to understand. There are a lot of common sense reasons why they can keep doing well and keep winning market share. You don't need to read loads of supporting notes about financial derivatives in the financials to understand how they can keep making money. You can just go visit a We Buy Cars. You can sell them your car. I unfortunately couldn't experience SA Taxi as a customer, and I certainly didn't understand all of the financial intricacies and risks in that thing. This, in my opinion, makes it easier to keep holding We Buy Cars, although obviously not necessarily forever. We've already discussed that blind love is for your kids, not your stocks. Third question, and the final one that I ask myself, what are the traded multiples telling me versus averages? If there's enough of a trading history, then take a look at the current multiples, like the PE multiple, versus where it has traded before. Yes, the share price may have had a huge run, but if the profits have matched and the traded multiples are in line with historical averages, then who cares? It makes sense if it's gone up, if the profits have also gone up. There's a very big difference between a share price trading on a PE of 15x after a 50% run or 25x also after a 50% run. If the long-term average is, say, 20x, then in the first example, where it's trading at 15, that stock is still well below its average despite the run, whereas the second example is a stock that is now well ahead of its average and at genuine risk of unwinding. In both cases, the share price has run 50%. That's the return. But I would probably feel a lot better about hanging on to the first stock and hoping it goes up to its average, whereas the second one is probably due to be trimmed or perhaps even sold altogether in case that multiple unwinds. My closing thoughts are around churn and taxes. Be careful of worrying too much about when to sell. When you sell, you are going to trigger tax. This can really hurt your gains over the long term, especially because you'll be taxed as income tax if you sell within 3 years, not capital gains tax. And you will then be compounding each year using your after-tax numbers, whereas those who just keep holding are enjoying the compounding effects on pre-tax numbers. This is why fund managers have an unfair advantage in the market, because fund structures typically do not incur taxes within the funds when they chop and change positions. Finally, be wary of the costs of churn. And I'm not just talking brokerage fees here, but also your time spent watching the market. That has a cost too. And so do the gains that you will probably miss out on over time by selling too quickly. Over the long term, markets go up. Isn't that why you are in them in the first place? The best companies will keep making all-time highs. That's what we want them to do. So be wary of selling, but don't be completely blind to it, as I have certainly learned the hard way. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.